Welcome back. Well, digital lending in Nigeria has rapidly expanded with over 200 platforms, including fintech startups, Chinese-backed apps, and traditional banks offering fast, collateral-free credit via mobile apps. But this rapid growth has surfaced some serious regulatory, operational, and consumer issues. We also see regulatory gaps, enabling predatory lending, high interest, hidden fees, and abusive recovery tactics, prompting the FCCPC and the CBN to enact interim guidelines and crack down on illegal players. Well, join us to unpack this now. We have Oluwatoyin Olaoye is the Chief Risk Officer at Vendorcredit, joining me via Zoom. Great to have you on the show. Good morning.
Good morning, Larry. Great to be on the show.
So let's look at regulation now. How well do the existing frameworks, we've seen coming from the CBN and the FCCPC there, trying to streamline, digital lending guidelines. How to address all those predatory behaviors and consumer privacy abuses, in your view?
Well, thanks for that, first of all. So what we've seen basically over the last couple of years is that there has been a lot happening in that digital space, right? And there still remains a gap between policy and enforcement, right? So while, like you rightly pointed out, we introduced the limited interim regulatory framework to rein in predatory lending, many digital lenders still operate in gray areas. And I think this sort of speaks to the fact that I think from a regulatory perspective, there's still a lot that needs to be done on understanding the digital lending space and putting the right policies in place to ensure that this doesn't happen. And also on the other end, to ensure that digital lenders are not allowed to operate in gray areas where there's no clear sign of policy, so that things like predatory lending can be nicked in the knob, right? So you have a situation where that gap exists between policy and enforcement, and so a lot of this is still ongoing in Nigeria.
So, where do you see jurisdictional overlaps? We have the CBN, we have the FCCPC, NCC, NITDA. Do this create confusion? And how do you think you can coordinate these different regulators there to have improved regulation?
So in situations like that, what I have done and what we have done personally at Vendorcredit that has worked for us is to ensure that you have a robust compliance team in place that understands the regulatory policy for each that has been issued by each of these regulatory bodies. So if it's from either the FCCPC, the SEC, or the CBN, right? You need to ensure that your team understands each policy and has a robust conversation with the regulators at all times, right? So, and what this does for you is that that engagement sort of allows knowledge to be passed across board. So in terms of, staying on the fine line of regulation, you are not caught out entirely, and you understand what the requirements from each of these guys are. And so in situations where you even have overlaps, right, you can speak to it and say, you've had discussions or you've adhered to certain rules that have been provided by the SEC, and even push back in some cases and say, oh no, this is not covered by this, what you guys are doing. We've already, aligned ourselves, or we've already adhered to it, obviously because this policy or the circular has been issued by another body. So you need to have a robust engagement with each of these bodies at every point in time to ensure that you are compliant on those fronts.
Right, and mostly digital lending, that happens mostly over the internet. Talk to me about some of the top cyber risks, faced by, the digital lenders. At this point, we know there's phishing, there's DDoS, internal fraud. How are they, navigating all of this?
So one of the top risks could be cybersecurity, right? Cyber criminals are getting more sophisticated. In Nigeria, as at the last data that we had, I think, between 3,000 to 5,000 cybersecurity experts, and that's just a fraction of the amounts that you actually need to nip this in the bud. And so for a lot of digital lenders, right, cybersecurity continues to be a challenge. I say this because a lot of lenders are also heavily reliant on third-party infrastructure, right? So if it is your cloud services, your KYC tools, for people who have outsourced their credit scoring to third parties, right? And so what this introduces is a lot of operational risk, particularly when you have downtimes or when data leaks occur. And so for us, it's a major concern. And once data is leaked, it erodes trust, reputational risk comes into play, and then data breaches itself can be devastating. And so what we've done basically to tackle all of this is to ensure that your IT and your risk teams are constantly speaking to each other, are constantly aware of what is going on in the space, right? Ensure that you have a robust multi-layered security architecture, right? Right from origination to disbursement to KYC. Ensure that at every point in time, you have people who are looking at it from both sides, right? You have a make and checker system in place. Your IT team and your enterprise risk teams are constantly communicating, and then ensuring that you implement strict vendor risk management for third parties, right? Policies in place to ensure that whoever is going to be providing a service that you yourself cannot provide, right, has the right cybersecurity protocols in place, right? And then you also need to continue training employees. At our organization, we do a random phishing exercise just to ensure that our guys understand the risk when they open, malicious emails with, dodgy email addresses or attachments. And so continuous training for your employees is very key, ensuring that both your IT and risk teams understand the risk and appropriately trained and are constantly aligned on what needs to be done.
Right, and talking about being always updated, at this point, do you think it's getting harder to protect, consumer data, with these digital lenders? And do you think that, we can get to a point where the security is so robust that, most of the consumers there are not afraid to give out their data to some of these lenders?
Yeah, I think we'll get to a point where security protocols will become robust. You cannot eliminate the risk of um, of leakages or cybersecurity criminals trying to get information. What you can do is minimize it to the barest minimum, right? And by so doing, ensuring that you have a robust security infrastructure in place also tends to enable trust. So in situations where you constantly, and I've also seen that what also helps is communication. So communication to both your stakeholders, internal and external, your customers, letting them know that they also bear a responsibility when they put their details online, but also ensuring that whatever details are stored with you are stored to the utmost security protocol to ensure that there are no leakages. I do believe that we'll get to the point where you have robust protocols in place that will minimize the risk but not totally eliminate it.
Talking about most of the digital lenders in the space now, do you think the market is oversaturated, or we have the right amount of digital lenders in the market?
Oversaturation. I think what you have right now in Nigeria is a lot of players who are offering the same thing, right, without a lot of differentiation. So it goes by different names, payday loans, salary advance, whatever you want to call it, but all of it is linked to something, right? An employee who has a steady cash flow at the end of every month that you can make a credit decision of, right? And by so doing, you've left out an entirety of the market, right? So there are people who supply vendors, for example, who supply goods needed for the completion of a service, right? You've not captured that there is the whole informal sector who make their money from buying and selling that are not appropriately captured. So it's not really a question of oversaturation, it's a question of the lack of differentiation, right? And what has happened is that, so you have so many people who have seen that there's an opportunity of some sort in that space and are chasing the same thing, and has led to this explosion of digital lenders. But what we do need to have in place is lenders who understand the marketplace and who come out with, products that can address the lack of credits, right? You can't go to a market woman and tell her that you are offering her a salary advance. If you don't understand her business, if you don't understand supply chain, if you don't understand her buying and selling. Same thing for somebody who, and I'll use the coastal road, for example, as a loose example, right? Who is probably supplying, sand or gravel that is needed to ensure that that road sees the light of day, right? You need a product that's, meets its needs at every point in time. And so I think that's where the issue is. So not so much an oversaturation, but so many players who are sort of doing the same thing with a lack of differentiation.
Right. All right. Let's look at some of the risks there, because I know you love to deal with or identify, some of the risk in your industry. There, we still have the macros there, inflation, currency weakness, and we have the tension in the Middle East right now. So, what risks are you seeing for that segment, so far?
So recent events in the Middle East. I think for us as a whole, I think we'll be able to dimension the risk properly based on the response from the other party, Iran, right? We've seen the US and Israel play their hand. And so what you're seeing right now is just people are slowly reacting to what happened over the weekend. I think a lot of it is also dependent on the response from Iran, right? Nigeria's benchmark for crude oil is $75. We've seen it tick up slightly to 78 over the weekend. Reports are saying that it would most likely get to 80. But like I said, all of this is also based on the response from Iran, and then that will determine, on the end. Obviously, there's a sovereign benefits. Higher oil prices leads to higher revenues for Nigeria as a whole, as a sovereign. But higher oil prices, since subsidy has effectively been removed, leads to increased petroleum prices. And what happens then is a shrinking of disposable income. And then you have also the risk of inflation, because once petrol price goes up in Nigeria, every other thing, follows suit. And then you now have to deal with that on a singular basis as is, right? So that risk exists, right? There's also the systemic risk that we have a whole, right? The digital lending space, where I believe that most lenders need to embed flexibility in their models, right? Dynamic interest rates, grace periods, because with whatever is happening in the macro has a significant impact on whatever you're doing as a business. And so you need makers to assist with stabilization tools. A lot of lenders right now do not appropriately or cannot appropriately ring fence their financing because of lack of things like guarantees or credit risk insurance. And that speaks to a whole different issue entirely, where because of where we are as digital lenders or in the economic space, our insurance products are not as sophisticated as we need them to be able to cater for some risk. But that's a whole different conversation on one side. And so these are just a couple of things that we're noticing,
right,
that going through, and hopefully, like I said, a lot of it is also dependent on what happens in the next couple of days with regards to the response of what happened over the weekend.
Right. Definitely a risk there. We have to find a way to mitigate those risks. Thank you so much. It was great having your perspective. Oluwatoyin Olaoye is the Chief Risk Officer at Vendorcredit. Thank you for coming on today.
Thank you for having me, Ladi.